Right, good morning and a happy Friday to everyone. Let's start with a snapshot of the US dollar. First and foremost, as those that have been following me for a while, we've been talking about this long term uptrend that started mid summer, and we've been talking about the prospects of this market slowing down, and we are in a situation whereby we are technically in a bearish scenario, given that we broke the uh, structural point right here, and we're currently using that as a bit of a support. But essentially, we've broken that level. If I make it exact with that magnet, all right. So we've broken it once, twice, three times. That was a very firm move to the downside. It left behind this M formation. Again, I like to use these as a foundation for potential pullbacks into the neckline, which is essentially what we've seen. So we've been talking about that for some time, and that's been playing out nicely. So that is currently a resistance level. And I'll just pinpoint that as an exact level, depending on which DXY chart you're using from whatever broker, but this is the one that I use. And that is essentially where we're at on a longer term time frame. And if the bears were to emerge at this point, then wouldn't be surprised. This is a resistance area, and we could start to see some pressures come in um, along this trend line support. Over the course of the next, this is zoomed in on that bullish trend, that correction. We zoom right into the hourly chart. We can see that that structural point here, this area here, has been broken in recent sell-offs. So that in fact now is a broken structure, and again bearish. So we've got a pullback into a resistance area. And what we might find is a reluctance from the bulls here at this point to keep coming up. And we could start to see this flip over. That is from a technical standpoint. I've just pulled the Fibonacci on that down leg. So the correction, it's a very firm correction, and it's come up into the 61.8. That's not to say that it's just going to blow off to the downside. So it's a bit of a wonky trend. So technically, we've got this move lower that has broken that structural point. So if you want to just regard this leg of the full correction as broken down. So this leg here is broken down. Then you've got this leg that remains intact, although it came down pretty firmly here, taking out this leg. And then we made a lower high and a lower low. So all of this to me is pretty, looks, it's a pile of junk really. So there's nothing in here that is particularly bullish. So which jeopardizes the correction as being bullish. So I'm going to call it a broken down market. And let's see if this doesn't just start to roll over. Right, so let's just clean up that chart entirely. That's enough explanation in terms of the technicals. All in all, I am bearish while below 106.20-ish. And, well, between there and 105, call it 85. So I'd expect there to be supply pressure. If the price were to move up into here, I'm expecting it to be a sell on rallies. Having said that, the US dollar has retraced nearly half of this month's drop. And So this drop here. Um, and it's been up for 4 straight days. Overall, the dollar is trying to claw back some ground as the market starts to realize that they're getting a bit carried away with the dovish Fed narrative. Um, Number one, you've got the US economy that continues to grow above trend, even as the rest of the world slips into recession. And you've got price pressures that remain persistent enough so that the Fed will not be able to cut rates as soon as the markets think. So we've got Fed speakers that continue to push back against the dovish narrative. And if the data from here on remains firm, and we've got something left today, the doves are going to have to capitulate, and the market for that matter. So just be aware of that. Technically, it looks bearish, but a move above 106.20 would probably invalidate that meanwhile bearish outlook. From a technical standpoint, given the fundamentals could be starting to turn. In yesterday's address, Fed Powell, the governor, the chairman rather of the Fed, essentially said he would not hesitate to tighten more. And he added that Fed policymakers are not confident that they've achieved the stance to hit the 2% target. And he also noticed that while policy was working in ways it should, some households and businesses are not feeling the impact of higher rates. And then lastly, he sort of finished up by saying that a judgment about whether it needs to do more. So overall, Powell, within the press conference, basically said what he said at the press conference. When was it? November the 1st. Yet the market is talking as if he's the second coming of Paul Volcker. So just bear that in mind. I think that, as ever, it's you can pick bits that are dovish, pick bits that are hawkish, and run with it. But that's where we are. At the end of the day, the reaction in the market was that the dollar gained sharply across the board after his comments, which probably goes to show how dovish the market has been in recent days. I mean, the 2 yields shot higher, trading near 504, and that was the highest since Powell last spoke on the 1st of November. All right, so I think that brings us an end to a coverage of the dollar. Overall, the US economy remains fairly robust, and today's data highlight will be the preliminary November University of Michigan consumer sentiment. And the headline there is expected to remain steady at 63.8. So let's see how that comes out. Yeah, all right, so we'll wrap that up there. In terms of the cycle, I like to use this template. We have basically, on the week, been driving up, up, and up, and up, and up. We've got no signal day. We didn't get a correction of that drive up. Perhaps today will be the day that we do, and that could set us up for a move to the downside next week. Or perhaps not. Perhaps we're just going to continue driving up. There's certainly nothing here that stands out that would say otherwise, only that we're starting to coil, and we're going to need to see this market get back above that closing price today. So we've sort of come down in Europe. We've based, we've made a sort of railroad track bottom here. This is on the hourly chart. So let's see if we can get above that closing price, and I would presume we can continue rising in line with the new or the renewed hawkish sentiment that came out of yesterday's speech. But bearing in mind, if we don't, that we are in essentially a broken down bearish market, given these moves that we talked about earlier in the video. So I wouldn't be surprised if we start to see some selling pressure. And in that respect, we've got yesterday's lows as a target, all the way down at 105.36. If we get back above the closing price of yesterday, which is that red line in the middle there of those wicks, if we get back above that, and then we can take out yesterday's highs, pairing today's highs, and potentially ending up back towards that 106.22. If indeed we get any sort of movement at all, we may just close very quietly into the weekend. All is yet to be seen. So let's move across to the other pairs.